And it looks like I am live. Welcome back. It's Happy Tuesday, Super Tuesday, or as one of our guys said, Super Thursday. Okay, so by the end of this, we should be knowing who's probably going to be running against Trump in the election, only because I don't want any comments. I'm just making jokes. Okay, so a couple of things, little feedback. One, I'd like to say congratulations to, I don't know if she's on today, but Nicole, she passed the other day. So happy for her. And I have another one who passed the other day, Saturday, another Nicole who passed on Saturday. So we had a good couple of days. Now, what a little feedback I got from some of the people is that, hey, Diana, is that they're seeing a lot of communications on the test. So everyone seems to be coming back. And remember, this is a top off. The SIE has some, and we'll talk about the SIE, but these guys passed the top off. And so the top off there's a couple of things that they had. And one of them is communications. They were really, they saw a lot of communications on the top off. Remember, if you guys have questions, feel free to ask. Okay. Orlando, that's an awesome score. So communications, let's talk about the levels just to have it, and then you can start throwing questions, or I get an early night, whatever it is. So first of all, there are 3 levels of communication, only 3, that's it. There is correspondence. Correspondence is basically just any recommendation that you send out to 25 or less people, okay? 25 or less people. That's correspondence. It does not need to be pre-approved. It's going to be reviewed. That's like if you work at a broker-dealer, and what happens is you work at a broker-dealer and they train you on the communications, and then you send out emails regarding, advice or whatever it is to 25 or less people. It doesn't need to be pre-approved, but it will be reviewed. I am stuttering like a candidate. Now, what that means is that they're going to read like 3 to 5% of your emails and take a look at them and have keywords that if you say like take over or don't tell compliance or complaint, all these things are keywords that will trigger a review. But they usually grab around 3 to 5% of your emails anyway. And then you may get an email say, listen, you were sexist, ageist, you made something wrong, whatever. That's correspondence they review after the fact. Retail communication is to more than 25 individuals. That means it needs to be pre-approved. That means your supervisor has to pre-approve before you send it. And that's where somebody on Reddit was talking about how he can't get hired because he has a mark because he sent a cold email. So I don't know the details, but it sounds like he might have sent it to more than 25 people without pre-approval. So you have to get pre-approval before you send out retail communication. That's to more than 25 of any individuals. Living, breathing human beings, you have to get pre-approval. More than 25 of them. Now, there's a couple of things that caveats are just going to kind of offset what I just said. So there's chat rooms which are non-static or public appearances. Since you can't control a public appearance or a chat room, you have to make sure that the person is trained in communications. And those are little modules you do every couple months for the firm. And you have to make sure that you review the stuff after the fact, since you can't predict what the person's going to say in public. Now, next step is under retail communication falls advertising and sales literature. They're treated the same way, but you got to know. Advertising is like a TV ad, radio ad. You have no freaking idea who's looking at it, but it's going out. Sales literature, you know who it's going to, you just don't know. Oh, you do. Sales literature, you know you're doing it to. You can send it to 1 million people. That's my old man brain forgetting what I was talking about as I'm speaking. That's how dumb I am. So retail communication, advertising is one where you send it out, you don't know who's looking at it. Sales literature, you're sending it out, but you don't but you do know who you're sending it to, but it could be 30,000. Hey, Bree, how are you? Now, another one is institutional. So all of those have to be pre-approved. Institutional is you're sending it to like a Merrill Lynch or hey, Allie. So you're sending it to a Merrill Lynch or a broker dealer or JP Morgan or a hedge fund. That's institutional, does not need to be pre-approved. You do not, hey, Masako. So you do not need to have it pre-approved because you're sending it to an institution who can defend themselves. That's why they have a thing for institutions that if you have an institutional client, they can fill out what they call a 2111. Don't worry about the numbers. It's a suitability statement saying, listen, we're good at what we do. We're institutions. We don't actually have to listen to the rep. So we're waiving that you know that if you deal with a client, if you speak to a retail client, you always have to do what's suitable for them. Judy, how are you? So now you always have to do what's suitable for your clients. But if it's institution, they can waive that and say, just give me anything you think will make money and we'll make our own decision. Institutions can do that. They can fill out a certificate saying, I am waiving the suitability requirements and I can make my own decisions. Okay, so I'm going to talk to your questions. I just had to make sure I know something that has showed up on the top off. I know that the SIE, and I'll take questions on all of it now. Okay. Now, I know, Peter, I'm working on it. I'm doing this to build up, to help people. And I make a lot of money tutoring. So I'm doing this for free. If I can figure out a way to do a video thing, I will, but it's not going to be the end all be all. You want to watch, a good thing for the SIE is you do that achievable link I have in my comments, but we'll see. Now back to this. Institutional is you don't need to get pre-approval reviewed because they can handle it. There's two more things that fall under here that may show up. If you are giving advice or retail communication for either mutual funds or variable annuities, again, for mutual funds or variable annuities, you either have to send it to FINRA before or after. Not for approval, you just have to send it to them so they can file it. If it has rankings or ratings in the advertisement, you have to send it 10 days before you publicize it. If it doesn't have rankings or ratings, you do it 10 days after or within 10 days. Again, mutual funds and annuities, you send it to FINRA, they don't approve. No regulator ever approves. If you send it to a mutual fund or annuity, if it has rankings or ratings, you have to submit it 10 days prior to first use. If it's not, then it's 10 days within 10 days. Okay, so now, a couple questions. Peter, yes, you find out right away. What happens is you go in there, you press the button when you're done, hit submit, and it goes, are you sure? Are you really sure? Are you 100% positive? You have to say yes to all of them, and then you hit it. And then that wheel starts turning. And you come out and go, and then it either goes pass and no score, or it gives you a score, which means you did not pass. It happens. People don't pass all the time. Okay, not my students, but they don't. Okay. Now, let's see. Okay, taking 7 tomorrow, munis, if I would feel the least confident. Okay, so understand something. That's a really big question. And I have, as I sent to Allie, if you look in my thing, I have a video on geo bonds, and I think there's a revenue bond. I'm not sure. It's about 8 minutes long. But I'm going to tell you right now, you have to know that munis are done by the state. They are exempt. Okay, that means they do not have to register. They also may not have to pay taxes, which we'll get to. So now, munis are issued by states. There's GOs and there's revenues. General obligation is for stuff that's free to use. It's for the free shit, like libraries, high schools, the regular roads, the park you walk in, all that stuff that's free. Where do they get the money from? From the good old taxpayers. So they get their money from what they call ad valorem taxes, okay? 7 top off and 6 top off. Both of them had communication questions on it. That's why I did this, okay? Both my 7 students and my 6 students. I know, again, I have to find a way not to look at the comments. Now, GOs are for free shit, okay? And where do they get the money, pay the interest and principal? From people's taxes, property taxes, volume, stuff like that, okay? Now, the revenue bonds, so GO bonds need voter approval ahead of time, because if you're going to charge somebody on taxes, you need to get their permission. Okay, I will work on that, Alex. So now, GOs, you use property taxes to pay, so it needs voter approval. They have debt limits in the various states. It means each city or state can only raise a certain amount of money, and it can only be used in the state. The only exception to that is what they call a coterminous or overlapping. Like if you played a sport when you're a kid and you went against this massive high school that had like 15 towns into it, down in South Jersey and mine, that's a regional high school. Remember, high schools are built with geo bonds, and normally it has to stay in the state. But they created it what they call overlapping, where they have one high school and there's multiple towns feeding into it. So the money is overlapping the town lines. Then we have a revenue. I remember I'm doing a high level. Kellen, look at my old, after we're done here, go look at one of my old videos. I have one on geo bonds, maybe one on revenue. So a revenue bond is one that is paid for stuff that costs you money. Like if you come into New York City, you take the GW Bridge or the Lincoln Tunnel or the Verrazano or any of these bridges, they cost money. They cost tolls. You're paying for them. So what they do is we issue a bond with a known project. We know, okay, we're going to build the subway line. We're going to build the Q line to go down to Manhattan and around, but we know it's going to cost money. So what we're going to do is we do a feasibility study first to say, okay, if we build this, will enough people use it to pay the interest we're paying on the loan? That's a feasibility study. A feasibility study is when you look at a revenue bond and you go, okay, I'm going to issue this. Will enough people use this project to pay the debt service, which is interest and principal on the loan? So first you do the feasibility study. Will it work? Then you do a legal opinion. That's the bond counsel. That's a lawyer. And the only thing they're good for is telling you whether you're legal and it's tax-free. They're not about suitability. Remember, legal opinion is not about suitability. And you want an unqualified, hey, Colleen, and you want an unqualified opinion. Unqualified means a lawyer says, we are good, it is tax-free, and it's legal to issue. So again, a revenue bond is for stuff that costs you money. Tolls, fees, rents. The World Trade Center was issued by a revenue bond. Hospitals, airports, anything that the city runs, the buses, that costs you money are issued by revenue bonds. So they issue a bond, build it, and then the money you spend pays for it. Here's the thing on this. This does not require voter approval because you don't have to use it. If you don't want to take the subway and you want to walk the 5 miles from 54th to Wall Street, you can do that. You do not have to go over. I just did legal opinion. Okay, now, I was talking to Orlando on that one. So now, if I issue a revenue bond, no voter approval required. There's no debt limits because basically what they do is what they call a debt. Oh my God, I'll come back to that. It is a bond coverage ratio. So the debt coverage ratio is, are there enough revenues coming in to pay the interest? That's a coverage ratio. Okay. That's what you want. Okay. Now, so revenue bond is no voter approval, no debt limits. We raise as much as you want as long as we have enough income coming in. And the money can cross the state. So if you're in New York and New Jersey share the Port Authority. They build bridges between the two cities or two states, and you pay to go back and forth. Well, you pay to come into New York. You don't pay to go to Jersey. I live in Jersey, and I know that if they charge a toll to get back into Jersey, no one will go. So revenue bonds are backed by the actual revenues of the project. So they have credit risk. They have more credit risk than GEOs in general. Because a GEO, they run out of money. They just grab taxes. I hope that helps a little bit. Now, legal opinion, I already talked about it. The bond resolution is just a document. You don't have to worry about what's on it that much. Just know the bond resolution is saying what we can and can't do. It has the covenants. Covenants are like what we do. Like a rate covenant says we promise to have charge high enough rates to cover the debt service and all that. Okay. The agreement among underwriters, I can get into it at some time, but I'm going to go very quickly on this. Agreement among underwriters is the same thing as a syndicate letter. It is the agreement, all the underwriters that are helping issue this bond. It is the agreement, like who's the leader, who's the percentages, whether it's Eastern or Western. Eastern is undivided, Western is divided. All that stuff is in the agreement among underwriters, okay? That's also known as a syndicate letter. That's something that's within the syndicate, the group of people helping to issue the bonds. A syndicate is a group of broker-dealers who are helping an issuer raise money, sell bonds, whatever it is. Okay. Now, when I say C21, I'll be there in a second. So now, Allie, AMT. So AMT is the bane of rich people. So what they did was they wanted to make sure that rich people paid their fair share of taxes. So what they did, no problem. So if you like what I said, I need to see the likes go up. That makes me feel better. It makes me feel like I feel the love if you hit the handles. So now, if I have a lot of money, what happens is that they can actually run my taxes differently. So what they do is, so say I make a lot of money and say I make 100 grand a year or whatever it is, and then I move up. Let me start over. AMT is a tax. It's basically, if you make a lot of money, see, sometimes I get crazy. If you make enough money, they start taking your deductions away. So every time you run your taxes, you're running regular versus AMT, and whichever one's higher, that's what you pay. But what happens is the more you make, they start taking your deductions away. So like my daughter, she had student loans. She used to get to write off the interest on the student loans, which means any interest she paid on her student loan, she could use to deduct her taxes. Thank you, guys. She could use to deduct her taxes. Also, here's my pitch. If you haven't subscribed, subscribe, because I just did another. I'm trying to work my way through the SIE book, then the 7 book. But this way you'll know when I put stuff on. And it makes me feel good. And this way you'll know when I post something, or if I send a poll out or something like that, which is my next thing. I'm going to try. So AMT, back to AMT. So the more you make, they take your deductions away. She had student loans. She could write off the interest, which would reduce her income, which means she pays less taxes. But what happened is she hit a number where all of a sudden that was grayed out. She could no longer take that deduction. That's what AMT is. AMT means the more you make, they start taking deductions away. And it applies to bonds, not GOs, never GOs, revenues and limited partnerships. Because revenue bonds, you don't pay tax on the interest. You don't pay federal tax on the interest. But since the IRS doesn't believe how efficient or how good the revenue bonds are, if it's what they call private activity, yes, private activity or industrial development bonds or something like that, they will take away your deduction. So think, if you have a GO bond and you get 10 grand in income from it, you will reduce your income by that amount. So if you make 100 grand a year and you get $10,000 in GO interest, you make 110. When you go to do your taxes, the IRS says, okay, take the 10 grand off, deduct it off, and you only pay tax on the 100. If you have a revenue bond, normally you can still do that. Normally, if you make 100, you get 10 grand in interest, you can reduce that 10 grand. But if the bond is subject to AMT, they go, oh, nope, you made 110 grand, you have to pay taxes on it. But usually it's someone who makes more than 100. If you make like 2 or 3 or 400 grand a year, they will say, okay, revenue bond interest is not deductible. You have to pay taxes on it. That's what AMT is. It's not an add-on tax. It's just taking away your deductions. So limited partnerships, which have a lot of write-offs, are subject to that for rich people who take deductions, and rich people who buy revenues might be subject to AMT. GO bonds are never, ever, 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 ever subject to AMT. You will never pay federal tax on a GO bond, ever. You might on a private activity or industrial revenue or some sort of revenue bond if the IRS determines that it's private or whatever. So now C21, I'm going to bring up, and I used to know your name and I totally forgot. Now, private activity is like a revenue bond that is strictly for profit. Like if they bought a building and rented it out, like if the city bought a building and then used the bond to buy the building and then rented it out just to make money, like a mall or something like that. I'm happy to help the alley. Now, you talked about the 66 real quick. Yes, it's boring, but you have to know certain things. Half the exam, half of the 66, probably 40 to 50% of it is going to be the rules and regs, what a broker-dealer is, what an IA is, what an agent is, all that stuff, Okay. That's going to be almost half the exam. Okay. Another 20% is product. So if you have the SIE or took the 7 top off, you will have about 20% overlap. But don't blow it off. You have to know what futures and forwards are, not the math on it, but know what they are, know what securities are, what the risks and rewards, some suitability. And then there's going to be a section on like future value, present value, stuff like that. If you go on to, I think Investopedia and Khan Academy, they're not, Investopedia and Khan Academy don't say Series 66, but if you type in present value, future value, they do little cartoony things that'll help you understand it. And I can always meet you for a lesson, whatever. But the point is future value, present value is a thing. Internal rate of return, discounted cash flow. Those are all Series 66 things. The first half of the exam, not technically the first 50 questions, but half the test is going to be about what a broker-dealer is, ethics, what a security is, registration and exemptions in the states. And yes, it's boring. Okay, so now, if you're going to invest, Allie asked about the tax equivalent yield. I don't know if you know you did that, but you did. Okay, so now, if you are comparing, so if I said to you, listen, I want to invest in a 10% corporate, and you said to me, oh, I want to invest in an 8% muni, okay? How do we know which is the best way to go? It really depends on who you are. So if you have a 10% corporate, you're paying taxes on it. If you have an 8% GO, you're not paying taxes. So how do we compare? Well, let's say you're in the 15% bracket. You're going to do 10. So if you're in the 15% bracket, that means you're bringing home 85%. If you're in the 10% bracket, you're bringing home 90. If you're in the 40% bracket, not that there is one, you're bringing home 60. So what you do, and I call it the opposite. So if you're in the 15% bracket, the opposite of that is 85%. So I would take the corporate and multiply it by the opposite. So I'm not going to do the math because 10 times 0.85 is easy. 10% bond versus an 8% muni GO, a 10% corporate versus an 8% GO. If I'm in the 15% bracket, I do 10 times 0.85. That gives me 8.5% after I pay my taxes. So that's better than the GO, so I would go with the corporate. But let's say I was in the 30% bracket. If I get $100 or 10% in a corporate and I pay 30% taxes, I'm bringing home 70%. So I'm going to do 10 times 0.7. Okay? 10 times 0.7. Okay? That gives me 7%. That's going to be, I'm only going to bring home 7% after taxes, which means the 8% GO is better. So if you are going to compare, do one or the other. You're either going to multiply the corporate times 100% minus the tax bracket, or you're going to divide the muni by 100% divided by 100% minus the tax bracket. So if I have an 8% muni, I'm going to do 8 divided by 0.85, or if I take the corporate, I'm going to do 10 times 0.85 if I'm in the 15% bracket. Don't do both, do one or the other. I hope that helps, Allie. Okay, so now, Peter, which is the best videos to purchase for the 7 top-up? Okay, here's what I tell everyone. I do not like Notman. I do not like them personally. I think they bash me. I don't know why, but whatever it is. But unfortunately, they have a pretty good product, so I have to send people to them. It kills me to do that, but I do send them there. I don't mind them that much. I don't like their questions a lot, but their videos are pretty good. They're not super boring. I think STC's videos are okay. Okay, STC's are okay. Notman's okay. Past Perfect app. Here's the thing. Training consultants' videos are actually the best if you can get past Tina's voice. Tina, if you ever see this, I really apologize, but the voice is so slow. The problem is they're very high level, which means they don't go deep into the weeds, but their videos are pretty good. My videos are the best, right? These. It's afraid. But if you're going to buy a video program, I think Test Geek's okay. Again, I think it's cheap enough. I think that he doesn't go super deep into it. Again, I don't know. I don't get a dime from these freaking guys, but I try to give an honest. Okay. Yeah, Kaplan video. The problem with TJ, that's awesome. Okay, so now, Peter, I agree. I'm not a fan of Kaplan because you're hit or miss. And sometimes they say stuff that I was like, you obviously are not in the business. because they say stuff that is just like, what the F are you talking about? And you call them and they don't really care. They'll feel bad, but it doesn't matter. You'll never get your money back or anything. So, TJ, I'm so happy for you. Okay. Okay. I don't have packages. I'm working on them. Okay. Again, okay. So, Peter, I'm working on them. If you watch these things, I try to do a little bit of both on these. And I am working on it won't help you guys right now, but future, please tell people. I am working through the SIE book, somebody's book. You can probably figure out whose it is, and you could read along as I do them, but I'm not going to get to the 7 top off for a bit. I may actually try to do both at the same time. Okay. Whoa. Don't be comparing me to Todd. Is it Rosenfeld? Don't be comparing me to him. What are you doing, Colleen? You're really insulting me. Okay. That is not good. Okay. We'll come back to that. I'm just kidding around, Colleen, but I worked with his brother. I was a compliance officer. Todd's brother was a prop trader, and he worked for me. He worked out on Long Island. I don't mind them. I'm actually trying to reach out to them, see if I can work out a deal. Okay. I think right now, Notmans have good videos, training consultants, and I thought STCs have gotten better. The problem with these guys is that you can't just buy the videos. Look, I think actually, and if it's a money thing, Test Geeks, I think videos are pretty good too. Now, Eddie. So the 6, again, I would stick with STC with those. I don't know if Notman does them or not. They might, but I think the 6 you could do that. Okay. Okay. Yeah. So no. Oh, don't confuse. STC and training consultants are 2 different companies. STC is Securities Training Corporation. Yeah, they're the big ones. I like their books a lot. But I just screw around about Todd. Training consultants is a totally different company. Training consultants is a much smaller company, and their videos are okay. So what I'm saying is at STC, the problem is I think all the videos are boring. I think Notman's a little bit better. But again, when you just see a video in a PowerPoint, it just fucking puts me to sleep. I just go right the hell out. I was like, I can't even watch that shit. Okay. Yeah, I'll do the POP. I almost didn't see that. So again, Eddie, the videos for the 6, I have some. I have one that called How to Pass the Series 6. It is strictly an hour. And anyone doing the 7, it helps. How to Pass the Series 6 video that I have is an hour on just mutual funds and annuities. And I think it's pretty good, but I'm arrogant and I love myself. So you asked about the POP. So calculating POP is not all that bad. Okay. So POP is always going to be NAV plus the sales charge, right? So the POP is a public offering price. It's a mutual fund. It's NAV plus a sales charge, which could be nothing. The sales charge could be nothing. Again, if I'm helping you, hit a freaking like. Okay, so now NAV plus a sales charge is the POP. If they give you the actual sales charge number, it's easy. NAV plus a sales charge equals POP. So if you have an NAV of $10, mother effer, Eddie, throw 80 banker out. I'm telling you, it's not even good for firewood. Do not do 80 banker. You will be stupider after you read it. You will start sounding like me, stupid. Throw it the hell out. Now back to this. Okay. Thank you, Luz. I totally agree. It is not even worth the firewood. Again, Exam FX should be underneath 80 banker. Exam FX, I'm not a fan of Solomon. Exam FX, 80 banker, and Solomon, and Fire Solutions, which is NRS, they are to be burnt. You run. I hope I'm not being too subtle about that. Okay. So now let's go back to this. I'm sorry, I'm going back to the POP. So now NAV plus the sales charge is BOP. So if they ask you, if they give you a percentage, if they say, you have an NAV of 10 and a 5% sales charge, well, it's 5% of the POP, not the NAV. So you have to do 10 divided by 0.95. I'm doing this. So that's why I'm doing this, Jessica. So if they say your NAV is 10 and your POP is 5%, you do 10 divided by 0.95. 10 divided by 0.95. That will give you. So you do, if you take the, just like that tax equivalent thing, I'm going to do the math on this. So if you do NAV divided by 100% minus the sales charge. So if I do, let's see, where are we? So I can't find a calculator because I'm old and blind. So if I have a 5% sales charge, I'm going to do 10 divided by 0.95. That gives me 1052. Yeah, you can't see that shit, but where's the camera, right? So I do 10 divided by 0.95 if that's a 5% sales charge. If it was like an 8% sales charge, I would do 10 divided by 0.92, which would give me that 1080. Okay? Does that make sense? I hope it does. Now, that's if they give you the percentage. That's easy. Now, if they say, oh, you have a NAV of 10 and a POP of 1050, what's the percentage? You're going to do, okay, 1050 minus 10, that's 50 cents, divided by 1050, not the 10. It's always off the POP. That's why you have to do that. Okay. So Jessica, I'm going to work, Alexandra, I'm going to work on that. Jessica, I hope that helps. If it does, I want to see a like. Okay. Okay. Joe, I think, okay. Okay. Why is interest not tax deducted on muni bonds that are borrowed? I don't know what that means. So come back to, I think, are you saying that? I don't know what you're saying on that. We'll come back to that. Maybe if we meet this weekend, I'll go over it because I don't even think that's a question. So now, Joe, FINRA restricted family members. Okay. So this is, you work for a broker-dealer. You are a restricted person. That means you cannot do what? You cannot buy on IPOs. Equity IPOs. You cannot buy on equity IPOs. You can buy them once they're traded. Jessica, let me know if that helps. So now, if you're a restricted person and you work for a broker-dealer, you cannot buy an equity IPOs. They're doing it so that we don't take all the deals. Because if you let us buy the equity IPOs, none of the good deals would get to the public. So it's basically you and anyone who lives in, how to pass the Series 6. Exactly. How to pass the Series 6. I think it has a blue border, a blue screen, whatever, thumbnail, whatever the hell you want to call it. I haven't changed it to my froofy color shit yet. Okay, so now. I hope you guys like that froofy stuff. I think it catches the eye, I'm hoping. Now, see, where the hell was I? Oh, my freaking God. Oh, restricted. See? So now, I work for a broker-dealer. I cannot buy an equity IPOs. I can buy once you're trading, but I can't. Now, this is what I tell you as restricted. One up, one down, one over. One up your parents, one down your children, brothers and sisters, and their wives. But your nieces and nephews can buy. If you see the word independent, then they are independent and they are not subject to it. I had a CEO of a bank, a broker-dealer, I was teaching, and he goes, wait a second, I can't buy in this, and my sister can't? And I go, why? He goes, well, she's been doing equity IPOs for years, but she lived in London, and he's not supporting her, so it wasn't matter. A lot of times, once you're an adult and they're on their own, it doesn't matter. So the whole point of that, it's only for equity IPOs. If you want to buy a secondary market, a secondary offering, or an additional offering of equity, or an IPO on a preferred, or IPO on a bond, we don't care. That's fine. Do it. Because really, preferreds and bonds are boring as hell. And if it's an additional offering, you're not taking advantage of anything. Here's a why. So think about this. Back a long, long time ago, I was at a hedge fund, and we wanted to get in on the Yahoo IPO. So I think if I remember right, I could be way off, but the IPO Yahoo price was $22. So anyone who bought shares on the offering got it for $22. The first trade was $84 a share. So that's where we can make 4 times our money like that. If you buy a preferred at 100, guess what it is after you offer it? It's still at 100. It doesn't move. It's boring. Okay. I hope I helped with the pop. Buy, stop. Okay, so let's talk about this. So now, I want everyone to write down slobs over bliss. SLBS, line, BLSS. Slobs over bliss. SLBS, BLSS. So slobs is sell limits, buy stops. And bliss is buy limit, sell stops. So slobs are placed above the market. Bliss are placed below. We'll talk about it a little deeper. Hold on, make sure that it's nothing crazy with my wife. My daughter's first day at work, back to work today after having the baby, was today. So it's a little stressful. Okay, now, yeah, I know I don't look old enough to be a grandfather, but I get it. Okay, so now, buy limits and sell stops are placed below the market. So if you are trying to protect, remember this, write this down. Stops protect, limits don't. Stops protect, limits don't. If you have a stop order, it's protected. So if you're a long stock, you would do a sell stop. You would place a sell stop below the market to protect it. If you are short stock, you would place a buy stop above it to protect it. Stops protect, limits don't. Okay, remember that. So if I have a buy limit, I'm just saying, listen, I want to buy 100 shares at 50. I don't want to pay over 50. I'll buy it at 50 or less. And you place that below the market. Because why the hell, if I said I'm offering something at 60, would you say, oh, I want to buy it at 61? That's just moronic. I want to buy it for less. If you go to one of the street fairs and the guy says, oh, I'm selling a Pashmina for $20, you're not going to say, I'll pay you 22 for it. You'll say, I'll pay you 18. And that's a limit. You say, I will buy 100 shares or a Pashmina at 18, or I'll buy 100 shares at 40. You place buy limits below the market to buy it and set a budget. Buy stops you place above, sell stops you place below. Slobs over bliss. And remember, which ones protect? Stops protect, limits don't. That's what you're going to get. If you're long stock, you do a sell stop. If you're short stock, you do a buy stop. Okay. Is that okay? Orlando. So the margin, you need to know the basics, which means you need to be able to get equity. You need to be able to get SMA. You need to be able to get buying power on both the long and the short. You need to know what minimum maintenance is, $2,000, $2,000, or 25% for the long or 30% for the short. You need to know that the equity, okay? Now, do you need to know every single adoration of it? No, because there's not that many on the exam. Okay. No, we'll get to that. Okay, so now, I'll come back to that one, Colleen. So now, margin, you need to know how to get those numbers. You need to know that if you sell stock, what happens to equity? And remember, always remember, equity, SMA, and that is always a relationship between market value and the debit balance. I'm not going into the math because that's what my students get. Now, but you do have to know that if you're selling stock, what happens? Does the market value or the debit balance change? I'm going to tell you, market and debit both change if you sell stock. If you add cash, only the debit changes. You can come back to that. You need to know that. Okay. Okay. Now, a buy limit so a buy put is placed below the market only because it's locking in a price to sell. Okay. Don't really put buy limits and buy puts together. They're different things. A buy limit, yes, you place below the market because if it gets down to a price, you just want to buy it at a price. You're setting a price. You're setting a limit. A buy put is like protection. You're saying if you're long stock, you're going to place a buy put. So even if it goes down, you could still sell it at that higher price. So if I'm long stock at 50, I want it to go up, but I'm afraid it's going to go down. So I will place a put, a 45 put or something, so that even if it goes down to 0, I can still sell it at that price. That's what the whole thing about buying puts are for. They're to protect you also. They do a better job of protecting. Okay, Allie, I think what you're saying is review corporate taxes. So they're not going to go into that, but what they will do is that if you are a corporation and you buy another corporation and you get a dividend, you will only pay taxes on 50% of that. That's one of the things. If you own more than 20% of the company, you will only pay tax on 30%, 35% of the dividend. So if you're a corporation and you own another corporation, you will only pay tax on half the dividend. If you own more than 20% of the company, you will only pay tax on 35% of the dividend. That's one of them. The other corporate tax is that if you're a C corporation, the corporation will pay taxes. Then they will pay the dividend after taxes, and then you will pay taxes on the dividend. Okay, so you buy, hey James, if you own stock and they make money, they pay taxes, and then they kick a dividend out to you, and then you pay taxes. So C corporations, the money is actually double taxed. That's why some people like buying limited partnerships and stuff, or even a mutual fund or a REIT that passes through 90% of their income. You don't pay taxes on that money. I mean, they don't pay taxes, so you're getting the money clean. So again, a C corp, they get money, they pay taxes. Whatever they pay in dividend, you pay taxes. A mutual fund or a REIT, if they make money and they distribute 90% of it, they don't pay taxes, only you do, which means you're getting more money. If you have a limited partnership and you get paid, they pay everything to you, and then you pay taxes on the partner level. I hope that helps. Okay. Hey, James, how are you? Welcome aboard. We're supposed to meet next week, but whatever. Okay, so now I think I covered most of it. Jessica, I hope it helped. I am sure I did, but okay, good. You did say yes. Okay. I think I got all the questions in. Okay, Eddie, I do lives. If you subscribe and do the notifications, you will know. But I do every Tuesday night, 8:30 p.m. Usually, I just finished with my students around 8. Sometimes I have California guys I do after, but I figure 8:30 is a time that I can do almost every time. Okay. Okay. Oh, that's funny. Thank you. I appreciate it. Because if you had strep, I would have thought you had coronavirus. Just kidding. Oh, it's cool. So yeah, every Tuesday night I do this. I try to do this, and then I try to throw a video out like once a week. Like I threw one out this morning, which is so stupid to do it the same day I'm doing live, but whatever it is. I'm trying to get through the whole book. Like I said, there's a book that I'm reading, and I'm trying to kind of go through it. I don't show it on the screen because I don't want a copyright problem. But if you figure out what book it is, which one of my videos kind of gives a hint, you can read along with me as I go if you're taking the SIE. Okay, Joe, taking the SIE Thursday. Have you taken the FINRA exam? If you haven't, you need to take it tonight or tomorrow morning. If you have STC, they have crunch time facts. Make sure you know that stuff. If you have Notman, they think they have class summary. Make sure you know that. That stuff people kind of saw in the exam. I think Kaplan has test facts. That's what they call it, and that's what people think they've seen. Other than that, the other vendors I don't think have anything. Don't sweat the math. Make sure you know risks cold. And I have a risk video. Go back and find that. You have to know the risk. You have to know interest rate risk, all that stuff. I have an older video. I think it's called It's All About the Risks. Now, you need to know the regs, like what a customer can do, opening accounts, stuff like that. Okay. Okay. So, Joe, I hope that helps. Make sure you do. Make sure that you do mostly reading tomorrow versus testing. If you haven't taken the FINRA exam, the FINRA fake one, that sample one, you got to do it just to see where you are. Again, if you're worried about the math, there's maybe one math question, current yield, or maybe yield to maturity, something like that, but nothing crazy. Okay. What about for the 6? And Clara, that Eddie, oh, you mean the book? Yeah, I'm gonna try to get through that, but it probably won't help you because I'm doing like 10-minute videos, and just do that. It takes like a day to edit it. Look, when you watch my video, you'd be like, you didn't edit it at all because it's crappily edited. But I did work on it, but I have no talent for that editing. Okay. Okay. Now, and Eddie, if that's not what you're talking about, clarify in the questions before I get out of here. Okay, so James, you want to know if you want to start a hedge fund. So a hedge fund is unregulated. Okay. So when are you taking it? If you're doing a hedge fund, it's not a FINRA broker-dealer, so there is no Series 7. You will need the Series 65. The hedge fund cannot hold it unless they have a broker-dealer arm. By the way, guys, if you do think I'm helping you, I want to see the little hands go up because it makes me feel better. It feels like I'm loved. So then I don't have to bug my wife as much, and she'll thank you. Although they still don't know I'm doing this. I think my daughter and everyone would be horrified that I am on live all the time. Okay. I'm not going to tell them until I get 5,000 people. that's the only way I'm going to do it. Because then I can justify it. So, James, I hope that helped. Only if you work for a broker-dealer can you have the 7. But again, like Bridgewater, D.E. Shaw, they have a broker-dealer arm that will do it. Okay, Eddie. I don't know when you're taking the 6, but understand you need to know mutual funds, you need to know annuities, and you need to know the communications. And then work on the suitability stuff. But I would read the book. I have a How to Pass the Series 6 one, which will help you. But keep reading and work on the communications. Guys, even if you're not around, go on Reddit. Go on Reddit and try to and take a look and see and type in search Series 7 SIE. Yeah, you'll see me make comments, but you can always find stuff in there. And most of those guys are not total jackasses. They're not total tools. And a lot of them will try to help you. Okay? Okay. I think we're in good shape. I think I got through some of the questions. I will try to kick out a video later this week. And mostly on the SIE. And I love talking to you guys. I love the positive. If you know anyone doing it, please tell them about me. Feel subscribe and like. My begging part. And anyone, if you need more questions, go on my link. I have a thing called Achievable. Click on that link and you can get more questions. And they do a pretty good job of explaining stuff. I also put a link for Series 7 for dummies. I think there's a Series 6 for dummies. I'll try to put a link in there too. And I think we got it. Okay. You are absolutely going to kick the 7's ass tomorrow. Kellen, I know you will. And so come on Tuesday night or even leave a comment when you pass. Okay. Judy, I will talk to you later. Allie, I will see you in a couple of days, and we got this. And y'all have a good night.